Hey, it's Bill Gross, the LA probate expert, with my weekly insights on the real estate market. Now, last week I said, get ready for a crazy real estate market this year. I meant for the year. I didn't mean right away it was going to get crazy, but wow, what a week in real estate. Let's jump into it and take a look at the details. So, the stock market, you may have followed on the news, dropped about 7% last week. One day, I think it was down 7%. And it was down significantly for the week. And that has a wealth effect because people often cash in stock for down payments or feel wealthier because the 401k or retirement program is based in many times on stock. And so overall, if you had an IRA or 401k maybe worth $1 million, on average today, it's worth about $930,000, which isn't a lot of difference. But if you take 4% of that $70,000 difference, it really reduced your monthly income by about $230 a month. That's like a brand new car payment, a brand new Honda Accord or something. Significant money for most people. So that has an effect on the overall economy. But I think really stock market is an indicator of the future of the economy and how wealthy people be. But there's other factors. The second factor is the continuing inflation. Now, I don't want to get in a political discussion, but clearly we have a situation where inflation is greater than 7% we're being told. I mean, I don't know about you. I go to the gas station, prices were 350, now they're 450, 480, about a 50%, 40% increase. Food seems to have gone up the same. The government's reporting 6.3%. It seems to me ground beef is up almost 100% from a year ago. And companies are cutting down on services, cutting down on coupons, trying to avoid getting squeezed on the margins because it's difficult for them to provide. So increased inflation is going to, again, hit people in their budgets because they'll have less money left over to save to buy a house or feel comfortable with a lower payment because things are costing them more money overall. A third factor to take a look at is Bitcoin. And while I'm not a big cryptocurrency guy, what I can say is it's a dramatic drop in value down to 35,000 by the end of the week, and it had been over 50,000 in the past, and just last week was in the 40,000s. And there are a lot of people who've put money aside and felt wealthy because this extra money they had in their Bitcoin was sitting in a bank account somewhere. And as that goes down, again, it's just another factor that causes people to feel a little bit less wealthy. Another cause, but the primary cause as far as interest rates for the feeling of wealth for people buying houses is interest rates. And while again, interest rates have jumped up dramatically, let's take a quick look at that, the activity from last week. So you can see that over the past couple of years, rates have come down. And through the pandemic initially, with declining rates, people were buying houses. And even though rates bumped up a bit, it took off some of the hysterically intense market into still a significant market. But now in the last 2 weeks, you can see we've jumped up about a 0.5%. And here's another graph that shows kind of the same thing in a longer perspective. But you can see that in the last couple of weeks, we've jumped up with interest rates now about 3.6% versus 3.5% not too long ago. So what does that mean? Well, for a homeowner who's buying an $800,000 house, each quarter percent is about $25,000 of value to them. Meaning for the same payment that they could have bought a house for $800,000 2 weeks ago, they can only borrow $750 today. Now, houses were going over the list price, and there was incredible competition at the market price. But what this is going to do is slow down the competition. And that's if rates stay where they are. They might go up, they might go down. There's no way to know. But at this rate, things have changed and the values of properties have changed significantly. So what's that going to do to the real estate market? Well, you need to know the market started off red hot. You really can't see it so clearly on this chart. But 2022 escrows are again on pace for last year's record numbers, well ahead of 2020, well ahead of 2019 and 18. Will that change? It feels like it. It feels like the brakes are being hit a bit on the real estate market. I wouldn't say crashing, but I would say definitely feels like the market's hitting a little bit. Now, the key factor that's going to protect the interest rate, the housing market, is the low inventory. The inventory in California, for example, dipped to the lowest record ever, 1.2 months supply. we've never had this low in the market overall. We've had that in certain markets, in certain cities, but this is the state of California overall. So as long as there's low inventory, you're not going to have sellers crashing prices like we did in 2008, 2009. What you will see, and this is the key number to watch, I think, is as inventory rises, the prices will slow down. That would be one of the key factors to watch going forward. Also to watch very carefully, in addition to the inventory levels, is the effect of the interest rates as they bake in over time. And what do I mean by that? So let's take a look at Fannie Mae. I'm no big fan of Fannie Mae. I think they were cheerleading buyers buying houses as the market was crashing in 2008, 2009. But it's hard to see here on this chart. I'll try to take it up a little bit. But if you look at their predictions for the future, in the out years, they're showing in 2022, they're predicting 3.6% interest rate margins where we are today, with a 6.9% increase in sales and prices going up by 6.2%. Now, historically, 6.2% is a great appreciation rate. If you're borrowing money at 3.6 and your house goes up by 6.2, that's how you get wealthy. But take a look at the next number. They're predicting next year, 2023, rates to go up to 3.9%. And that will cause appreciation to go down to 2.5%. So this is why the interest rates are so important, because obviously, if you're borrowing money at 3.9% and your assets only increasing at 2.5%, doesn't make any sense. Now, of course, you're leveraging, you're putting a small amount of money down, and maybe 4 times your money is going up at 2.5%. That's getting a little complicated. But my point is, you can see as an investor that as interest rates go up, it makes the advantages of owning real estate come into question. Now, will rates crash? Will values crash? 2 things are different than last time. One, as I mentioned, the inventory. Until there's a lot of excess inventory, prices can't crash because sellers just won't sell at the price that's being offered, and they will take it off the market. Second big difference from 2008 is that we don't have adjustable mortgages. The market in 2008 was built on people who bought a house they couldn't afford, assuming they could refinance next year. That's not the case here. While buyers have been able to refinance many times the next year, the year after, they're not buying it and not able to afford it based on that. That's the key difference. So while I do think we'll see a significant slowdown in the appreciation as rates go up, I don't think we're going to see the crash that people are predicting. Well, it will feel like a crash to those industries built on increasing sales. But in reality, if you buy a house, you have a 30-year fixed rate on your property, you can afford the payment, over the next 30 years, your house is going to go up significantly. This won't affect you. If you're an investor and you locked in a rate for 5, 10, or 30 years, and your rents are only going to go up based on inflation, you're well protected. It's the new buyer who has to recalculate the market and the new seller. So what do you do? What I would say is if you have to sell, sell. But let's be smart about it. Most realtors in the market today have never experienced a declining market of values or interest rates, or an increasing rate of a market of interest rates. But that's why you have contracts. That's why you need to have a professional agent to look out for your interests. So if you want to sell, it's still a great time to sell. Low inventory numbers I showed you, but we got to lock in that buyer and make sure they're going to execute and close on the deal so you get caught halfway. And if you're a buyer, very important, before you get caught into a contract, make sure you know the interest rate. Make sure you can lock it in at a rate that makes sense for you. Where rates headed next week? I don't know. Could they jump up 1%? I've seen it happen. Can they go back down 0.5%? I've seen that happen. Most importantly, let's pay attention to the key factors: interest rates, in the inventory. Let's make sure we make the best decision for you in your situation, not the market overall. So if I can help, call me, text me, email me. My information is down below. I'm here to help you, and let's make this your best day ever. Thank you so much.